This morning it's an absolute pleasure to have with us the chairman of ESMA, Steven Maijoor. We want to look a little bit at kind of this year, the unique year, the COVID year, but in general, very unique year, but also looking forward towards the work program of ESMA in 2021. Steven, maybe I pass over to you straight away to kind of maybe reflect a little bit on this year and on what you've seen and your kind of impressions of 2020.
Thank you very much, Nick, and thank you very much for inviting me. Very good to connect with you in a remote way. Obviously, if I would have been in Brussels, I'm sure it would have been a dull, typical Brussels day with a lot of rain, I suppose. Same here, I must say, in the Netherlands. Maybe looking back at, and although as we're getting towards the end of the year, I think it's good to look back, and I would like to particularly focus on two issues this year. Obviously, the most important one being the COVID-19 crisis, how that surprised all of us earlier this year, and the major impact on the financial system, on financial markets. Obviously, the period between March and April, that turmoil period, was a very important period for all of us, but also for ESMA. What we did at that point in time was really increasing the coordination with all national securities regulators, having very regular weekly calls. Sometimes I think there's been also weeks where we had 3 calls with the whole board of supervisors. And basically the role was to assess the developments in the financial markets, assess the risks in the financial markets, but also providing guidance to the financial markets, in the sense that where we could, we provided guidance to help market participants focus on business continuity. And for example, we've delayed some obligations because we knew that market participants were under stress by moving away from, let's say, the office situation to a remote situation. We have also provided guidance on, for example, IFRS 9 relating to the extreme levels of government support measures and how that could impact, for example, the obligations related to loans. In addition to that, of course, looking back at that time period, we can see is that most of the stress in the financial system was this time in the non-banking sector, while if you compare it with the global financial crisis, at that time, most of the stress was more focused on the banking system in connection and related to the sovereigns. And looking at the non-banking sector, I think we can be satisfied for how generally the market infrastructures have performed. Trading venues had to cope with extreme number of transactions. CCPs had to respond to extreme volatility. And I think where we can look back with satisfaction is that this is the first time that basically CCPs were stress tested in reality. It was a situation where, as you know, gradually over the past years, we have increased the role of CCPs with moving to more central clearing. And overall, we're satisfied with how that has performed. Where most of the stress was within the non-banking system was clearly in issues related to areas related to asset management. As you are aware, I have said, but not only I have said it, but also other regulators, both in Europe and across the globe, is that money market funds did not respond properly to the stress in the financial markets, and it's clear that the central bank interventions were needed to ensure that money market funds, or at least some of the money market funds, could continue to meet their regulatory requirements. And that is an area where we need to look at, and that is actually already happening now, is that we need to look at what kind of policy responses does that require, considering the stress that we saw in money market funds. Regarding open-ended funds, I think what we could see was an increased use of extraordinary liquidity management tools, clearly much more than in normal times, but the absolute levels were still quite modest. And so we are less concerned around what we are seeing there, although in a number of individual cases, I think open-ended funds, especially the ones that relate to real estate and corporate debt, they need to look into whether they have the right, for example, the right alignment between their investment portfolios and the rights that their investors have. Maybe to conclude as an introduction on looking back on the financial markets, is the current concern obviously is the so-called decoupling between the financial markets and the real economy. Although we have, of course, seen some positive news with the possibility of having effective vaccinations now starting very soon, the fact that equity markets are breaking records while the underlying economic situation is very problematic, loss of growth, and that in itself, of course, raises concerns for us as regulators. Maybe the second topic that I would like to briefly touch upon, and then let's hear from you whether you would like to follow up on any of these topics, Nick, is the peer review, the fast-track peer review that we conducted regarding the supervisory response in Germany to the Wirecard case. That is obviously a very different nature than the stories that I just shared with you on COVID. But I think what is unique about that case is that it's for the first time that we did such an extensive peer review into one country, into one case. That is justified considering the seriousness of the case, in the sense that obviously the failure of Wirecard has negatively impacted investor trust, and therefore it's important to see how the various lines of defense have worked, including the role of governance, including both at the Wirecard itself, how auditing has performed. And what is relevant to our remit is how the supervision has been conducted in this case by the German supervisory authorities. It was an in-depth assessment of the performance of both BaFin and FREP. FREP is the private sector body that is basically in the first tier in Germany, assessing the proper application of financial reporting rules by issuers. And so we look both at FREP and at BaFin, and the recommendations from the report, which were issued by the peer review committee, are to the benefit of the current review that is ongoing in Germany regarding the supervision of financial reporting. I think what is important here is indeed it is a one case in one country. But also I think what is good is that it shows that ESMA as a body is also able to deliver in a short time a very thorough technical assessment of the supervision of national competent authorities. But let me stop here, Nick, and hear whether you have any follow-up questions.
Thank you, Steven. I think it will not come as a surprise. We're getting questions in already. I think more for the second part at the moment. So I will come back to that. But I want to use this opportunity to remind everybody listening that you can post questions through the Q&A function. And please do. I will try and bring them in. But maybe to start with, I think first of all, yes, congratulations. I think your response, the response of your members to the COVID crisis on the conduct side, I think has been remarkable. The flexibility that you were able to show in the early days, as you say, about home working and other aspects, I think is very laudable. So really much appreciated. And also I think, the consistency of approaches we saw in the US and other jurisdictions taking similar approaches to these issues shows, I think, some degree of international coordination, not just on the prudential side, but also on the conduct side. And I think the speed of that cooperation compared to 2008, 9, 10, I think was remarkable. So congratulations on that. As you said, you had a very close supervisory cooperation, and with the ESA review entering into force at the beginning of the year, the whole issue of supervisory cooperation, coordination is becoming more important. I know you will touch on that in a moment, but what have you learned from the crisis about how to work with the NCAs, how the supervisory cooperation works? And is there things that emerged from that you want to take forward into the next years, or you would recommend your successor to take forward into the next years?
Thank you, Nick, for that question. I think what I find interesting on the time period, and of course recognizing how much havoc the COVID-19 crisis creates across the region, across the globe. What worked very well is the level of coordination with the national securities regulators was completely different and of a much higher level than we observed, for example, in response to the global financial crisis and the sovereign debt crisis. And so where it improved very much is the information position that we had. And I know that we receive now and then complaints from stakeholders around the obligations to report and the costs that it implies. But it really helped us to understand what was happening in the market turmoil of March and April. So you should realize is that we got within every few days we got updates with information on margins, on number of transactions, on issuance of capital, on the use of liquidity management tools, on settlement fails. And so the continuous availability of intelligence on financial markets across the EU was so much better than, let's say, the previous crisis. So I think that is really an improvement. I want to thank also all stakeholders, including the ones that are here in the call, for the contribution that they have delivered on that. Again, I know that there are complaints and there's concerns about the cost of these data, but I can assure you that we really use the data. The other thing that I would like to emphasize is obviously being in a better position to understand what is ongoing, you also then subsequently need to change that into policy reaction, into, can we give guidance to market participants how to, in this case, it was mainly about relief because and helping stakeholders, market participants, to focus on their organization from a business continuity perspective. And there was, and I think this is very positive, there was a clear focus from the national regulators to say this needs to be decided upon in a collective way. If we make any changes here, we need to do it at ESMA level. And so when concerns were raised at national level, very quickly those concerns were discussed in the board, and we have taken decisions in some cases to give guidance, but in other cases also to say it's not appropriate here to provide relief, and a real sense of cooperation, working as to some extent nearly as a collective supervisory body to make sure that there are consistent responses to the crisis. I think that is anyhow a process over the years that I think has been improving very much. As you probably know, there is in the ESMA regulation this concept of working on a common supervisory culture and really trying to get to a network organization that functions as a collective. And clearly, during the market turmoil, you could see that there is a focus on the center and a will to work together and get to common solutions.
Thank you. Maybe, Stephen, just two follow-up questions on the kind of looking back at the year, and then maybe we move to moving forward. One is on money market funds. You raised, and I know you've talked about money market funds a few times now as a potential concern. I mean, what concrete actions could you envisage? because listening to the industry, I think they've got some merit in saying that, we have to look at what happened in money market funds in a more broader macroeconomic context, and that the crisis elements, or let's say the tension, was kind of resolved within a relatively short period in March and April, and therefore, of course, are pushing a little bit back on policy action. So to what extent is this unique to money market funds? To what extent is this a broader macroeconomic fallout from COVID?
No, I think it's fair to say that money market funds were under extreme stress because the market for let's say short-term paper was not functioning properly anymore. And then the question is, of course, to what extent is that an issue which you basically can allocate to the money market funds, or could you say, well, this is an issue around the underlying markets that didn't function well, and it would be difficult to say that we need to look at the funds themselves, the money market funds themselves. My take on this is we need to make sure is that the financial system is sufficiently strong, and we need to, and there can always be surprises in certain liquidity drying up in markets. That is also what we saw during the global financial crisis, is that the markets for structured products were starting to be illiquid at that point in time, and so that certain underlying markets may not perform well under stress conditions. That is something that needs to be taken into account, and there the various vehicles that we have, the way that they are designed, they need to be robust and adequately respond to these situations. That is not to say that we should also look at what can we improve, for example, in terms of liquidity of these underlying markets. But it's also clear that some of the mechanisms did not work well regarding money market funds. For example, we know that there is this mechanism that if LVNAVs are not able to stay within the collar, if that they need to have or there should be this possibility to transform to a VNAV, and it was clear that because of potential stigma effects, is that mechanism didn't work well. We also know is that the fact that some money market funds were approaching their limits, the thresholds of their liquid assets, if that in itself might have induced some further investors stepping out of the money market funds because they were concerned about the possible impacts of gates and fees. And so we need to look at that. We have clearly what is important here, maybe two things very important, and as a final comment on this matter, it will be important to engage with the industry, to engage with those that will be subject to these reforms. And so we will make sure that there are sufficient possibilities for feedback from money market fund industry when we're considering these changes. And the other thing is, of course, this is not only an issue which we are recognizing at European level, but it's also recognized in the UK and globally. And so clearly the global debate on this matter will also be important for coming with the recommendations in this area at the European level.
Thank you, Steve. As you know, that was a very contentious part in the MFF regulation, so it'll be interesting to see during the negotiations. So it'll be interesting where this ends. I think one last point on the looking back, and there's a few questions that came in on this, not surprising, is around Wirecard. But I think the questions all are around supervisory structures in the European response. You rightly said that this is really a German domestic issue. We've had similar issues in other sectors like, I don't know, Enron and Parmalat and God knows what. But what preliminary conclusions or thinking is there from your side as to a European response? Do we need, and this came from Carl Lanou, for example, to have a stronger European audit oversight or supervision? Another question was, does this kind of reinforce your thinking around, I know we talked about that maybe at the end, CMU and stronger supervisory structures at the European level?
Well, first of all, I think we should be careful to extrapolate from the German Wirecard case to, let's say, make general conclusions on supervision of financial reporting. I think it's fair to say we have looked into one case in one country, and so you need to take some care when drawing broader conclusions around that. We're looking now into that matter as a board of supervisors. What does it say around, let's say, the transparency directive? And you can be sure that we're discussing issues like we have argued in the past that these guidelines, the guidelines on the enforcement of financial information, they were basically the yardstick that we used to evaluate the German supervisory system. We have argued in the past that these guidelines is that they should be having a stronger legal backing, and, for example, should be technical standards. And I'm sure that we will have that discussion again in the board. Other elements that is clear from the conclusions from the report are issues around information exchange. And of course, that is a conclusion which, to some extent, is generic that we also can find in other issues around improving supervision, is that typically information exchange can be constrained very much. And so also these issues, we concluded, for example, that in the specific case, that there has been barriers in the information exchange between BaFin and FREP that were not helpful in meeting the requirements around the guidelines. And so that is a dedicated debate that we'll have. Separately from that, and maybe already to go a bit further and looking forward, Nick, on the general supervisory structure, and decoupling that from the debate on Wirecard. Looking back at the past 10 years, what you can say and what we have seen is that ESMA has gradually improved in terms of convergence powers that we have, and also the type of activities that are under direct supervision. And so what we could do in terms of convergence tools in 2011 and direct supervision at that time, very differently now. For example, and we have used that, I think, to the benefit of the Wirecard case. I think our tool for doing peer reviews has improved with a better balance between the composition of the peer review committee members, and there's now half is, let's say, European level ESMA staff, and half is coming from the national securities regulators, and also on the side of direct supervision. While when we started in 2011, at that time it was only credit rating agencies. Obviously, over time, trade repositories have been added to that. Third country CCPs. We're now preparing also for data reporting service providers, and there will also be critical benchmarks. And what I really hope is that in the years to come, is that process of stronger convergence powers and more activities supervised directly at European level, that process should continue in the years to come. The fact that we have a fairly integrated European capital market, but most of the supervision is done at national level, that creates inherent weaknesses, inherent risks, and that need to be repaired with proper coordination, convergence measures, but also some activities directly supervised at European level. And I would really hope that process will continue in the years to come.
Thank you very much, Steven. I think it's good that you kind of start to look forward. I think maybe I give you a few minutes to set out a little bit your thinking around the work program. There are important issues in there, from sustainable finance, MiFID review, response to Brexit, CCPs you've just mentioned, direct supervision being introduced more on critical benchmarks, and data providers. Maybe just I give you a few minutes to set out a little bit your thinking for the year ahead, and then we come back with a few questions.
Well, so let me take a few minutes on that, and I'm sure that there will be follow-up questions to these matters. For those of you who are following us closely, what we have done at the beginning of this year is to issue a strategic orientation document for 2020-2022, and some common elements from that strategic orientation are, first of all, being even more disciplined in that supervision and supervisory convergence should start from a risk-based analysis, and so looking into the financial markets where there are risks that may have a significant impact on stability, on investor protection, and orderly markets. And of course, for that, you need to further improve data availability and data quality. And so continuing to work on data quality issues, improving our data, and you will see that we have gradually improved also for the outside world the information on European securities markets. That will continue. Related to that is that this risk and that information should also be a driver for the convergence work that we are undertaking together with the national securities regulators. One of the new requirements under the ESMA regulation, and I see it as an opportunity, is not only is that together with the Board of Supervisors, we determine what should be the work program of ESMA, but there's now also this requirement and possibility is that it partly affects also the work programs of all 27 national regulators, and they need to reserve time for that and resources for that, and that is called that are the so-called common union supervisory priorities. We have identified them for the years to come as being, on the one hand, data quality, and especially related to transparency under MiFID, and so that will be a priority for next year. The other priority will relate to the costs and fees that are incurred by fund managers. We have in the past years, and that also relates to, of course, the Capital Market Union, we think it is very important that there is broader participation by retail investors, households in the capital markets. Funds are a very logical instrument, product to be bought by households, by retail investors. There's clearly opportunity there, also from a CMU perspective, but also from an industry perspective. But we are concerned around the cost and performance and efficiency of those products. Maybe more broadly, and if there's and you will be very much aware of this, there's a lot of actions under the CMU on which we will be active. Issues like the single access point to information on European issuers. What will be obviously important, and I'm very happy around that being now part of the action plan, is broader retail participation. And so that relates also to making sure that we have efficient products, low-cost products that deliver what the promises that are given to retail investors. And so also looking at investor protection issues there will be important. Maybe then a few final remarks, and then see whether there's any follow-up questions on credit rating agencies and CRAs. Credit rating agencies, CRAs and CCPs. First, on credit rating agencies, that obviously is now an area which is already under supervision for nearly 10 years. I consider that to be quite mature in terms of establishing the supervisory, a good supervisory expertise, having the right people in place at ESMA, but also making sure that the credit rating agencies meet the requirements of the legislation. Obviously, we have in the past year looked very much how did credit rating agencies respond to the COVID-19 crisis, because downgrades played obviously an important role in the market turmoil, and also after the market turmoil. One of the issues where we want to look at relating to credit rating agencies is to find the right balance between, on the one hand, making information on ratings freely available to users. As you know, we have this so-called ERP, this platform where you can use information, which is basically organized by ESMA. But what we can see is that the use is quite restricted. And we also know that the information that is made available by the credit rating agencies themselves has limited use. And although I fully understand that that touches upon the business model of credit rating agencies, we have already done a call for evidence on this matter in the past year, and it's important that we progress further on that topic. Finally, on CCPs, obviously next year, as we have announced, we have registered, or we will register after the end of the transition period, 3 UK CCPs and 2 of them as tier 2 CCPs. So we need to implement there also for example, comparable compliance. I should also mention that today the new chair and the 2 independent members, Klaus Löber, Nicoletta Gusto, and Fraukelin Wendt, is that they start today at ESMA in the role as chair for Klaus, and Fraukelin and Nicoletta as 2 independent members of the CCP Supervisory Committee. They will be involved in this matter of comparable compliance. But what is also important is that they need to do this assessment around, are these CCPs so systematically important, is that they should not be recognized, but rather focus on relocation. And I think that is a task for the new CCP Supervisory Committee to look into. Personally, I think that the discussion about relocation should be linked also to a discussion on bringing European CCPs under European supervision. I think it is a debate about relocation, but subsequently, if you would decide for that, and if you would go in that direction, then that this would be done by CCPs that are supervised at national level. I think there's an inconsistency there. Also, of course, we know is that CCPs are very much interconnected. That is another argument to look at the supervision of EU CCPs at European level. But Nick, let me stop here and see whether there's any follow-up question to these matters.
Yeah, many questions. I see what we can manage time-wise, but I think maybe let's kind of continue on the last point you've raised, which is around CCPs and the CCP Supervisory Committee. It was nice we had Klaus with us last week twice. He did 2 things on behalf of the ECB, kind of as a kind of parting gift, so to speak, I should say. And we've got Heath Tarbert speaking in 2 days' time about comparable compliance and the experience there. But in the absence of that committee having to find its feet and so on, it's not easy doing that kind of remotely as well in the current environment, and they can't be in Paris from day one. But what advice would you give them? Because there's kind of this question, and there were a number of questions that came in about the need to rebalance systemic risk in the derivatives market, the question around relocation, or, well, let's call it politely rebalancing. Where do you see that going between the EU and the UK? I know there are lots of questions on Brexit, maybe for the end, but what advice would you give them as to how to approach things? There's also been, of course, a bit of a dynamic relationship between the Commission and ESMA in the development of the level 2 measures and the exact, assessment criteria that should be used. And finally, maybe linked to this, one of the priorities going forward, and this is on the ESMA side rather than on the Supervisory Committee side, is of course still looking at the clearing obligation and looking at some of the thresholds under EMIR. So maybe you might want to say a few things around that. I know that's more the EMIR refit than the supervisory piece, but just kind of keep that as a block of issues.
So on maybe first on the threshold issue, the EMIR refit has made some amendments to the thresholds, and at this stage, I think we should first work with that and then take it forward. So no further comment at this stage on that matter. I think on the issue around whether a CCP, a third country CCP, is should be considered not to be recognized. For those of you who know EMIR in detail, there can be there can be in addition to the reason that it's so important from a stability perspective, is that you also should be able to coordinate well and to work well with third country regulator, and so that is also part of the discussion on this matter. Let me start from the perspective. ESMA is probably one of the organizations that has been the most supportive of, let's say, global solution in the sense of recognizing third country entities, helping with equivalence advice to the Commission, and we have always taken this global perspective. And I think it's very important that that should also be the base case. The base case is doing this from a global perspective, and that financial market activity should be conducted in such a place where it is, where you have expertise, where it's efficient, etc. But it's also important to say, of course, is that Europe continues to build on that expertise within its own borders. At the same time, as I just said, there can be the issue around cooperation. We work currently very well with the FCA, with the Bank of England, but you should have let's say, and I've called it before, a plan B. You should have a plan B available in case there would be problems in the cooperation, and also when there would be this issue around being too systemic to have it being executed outside of the EU. But as I just said, I think in my view, that should be linked very much to also a debate on the European supervision of EU CCPs. The somewhat odd current situation is that at European level, we now have more information on third country CCPs than we have on European CCPs. And of course, the situation has much improved. EMIR 2.2 has also improved the level of convergence that is required and the convergence measures that we have. But in itself, I would hope that in the years to come, that there would also be further progress on EU CCPs.
Thank you. Steven, I don't know whether we can keep you maybe an extra 5 minutes because there's a few other questions.
Let's stop at 45.
Good. Then I think the questions on sustainability, I take one on sustainability, I think, and one on the AFMD, and then I would like to end up on Brexit and see how we manage that. On sustainability, Javier Arias made a good point from BBVA, which is, of course, you're very involved in the whole setting of sustainability principles and standards around MiFID and securities markets. But his concern is, and I think it's true, is we will see a proliferation of these standards and rules by different financial centers around the world. How do we ensure international consistency, and how do you work with some of the other jurisdictions outside the EU to try and reach convergence in some of these areas?
So I think that is a very, very good point. And what is very important is, of course, we know that Europe is really in the forefront here in terms of sustainability reporting, both for the financial sector, but also for the non-financial sector. ESMA, together with EBA and IOPA, are now very much involved in getting, let's say, the disclosures, working on the disclosures for the financial sector. There will also be work on this for the non-financial sector. What is obviously is important is that there is alignment between those standards that apply to the financial sector and the ones applying to the non-financial sector, because ultimately a lot of the reporting, for example, by asset managers, need to come from the companies they're investing in, and therefore there needs to be this alignment with the reporting by non-financial companies. And in addition to that, and I think rightly so, is we need to ensure is that we're progressing here well in coordination with international development. Of course, Europe is here in the forefront, and we should not wait until also other regions are progressing. On the other hand, it is clearly beneficial both for European capital markets but also for global capital markets when the standards on reporting are global and consistent. And so it is very important that we ensure consistency here. On the one hand, progressing and Europe being the leader in this area, but of course also trying to ensure that we have global standards that are as consistent as possible with the European standards, and that in itself would, on the one hand, of course, make it better available for investors across the globe to compare these sustainability disclosures, and they would also reduce the cost for issuers in terms of compliance with these different sets of reporting. Final point to be made on this is, of course, is that we should ensure the public interest in this area. Non-financial reporting is currently determining how capital is allocated. We talked earlier today around Wirecard, the Wirecard case. Every time that information is deciding or is playing an important role on a decision where capital is allocated, there's the risk of not proper reporting, not sufficient transparency, or in some bad cases even opportunistic reporting or misleading information. And so that is the other point I would like to make. It is really important that we get this right. The public interest perspective is here very important to ensure that we get reliable reporting, both on standards for the financial sector and for the non-financial sector.
Thank you. I think maybe grouping kind of the next group of questions together in the interest of time, which is, I think, in the context of Brexit, the big question, of course, is now the derivatives trading obligation, the DTO. You've moved on the share trading obligation, which was well received by the industry. I think any words you can say on the DTO, and maybe more broadly, I think looking at the MiFID review and the AFMD review, you've done a lot of reports, a lot of consultations around that. To what extent will that work, your advice, look to some extent over the channel as to what the UK might be doing? Because conduct is an area in which divergence quite quickly can lead to, diverse market flows. And so as you look at a review of MiFID, as London might be starting to look at a review of MiFID or the AFMD, how do we align those two somehow? What type of a dialogue might you foresee there?
So, I think we have, this is, considering the time, this should be the last question, if that is okay, Nick. And let's try to be short on this point. So obviously, a preferable situation is a situation where is a situation to have equivalence, and because that allows to take away friction between markets. At the same time, and that was also agreed in the withdrawal agreement, at the same time, where a concern is an understandable concern, and that has also been shared with me and with all of us, is the uncertainty around the divergence in the UK regulatory system. And I must say, we should take that point very seriously. What I've explained in the beginning of this interview, Nick, is how in Europe we have learned how important it is for financial market functioning, is that the rule book is consistent, and that supervisory actions and supervision is consistent across the EU. And if you look at the past 10 years, we've gone to a model and to a world within the EU where we have moved away from directives and we went to regulations. And also our supervisory convergence measures have improved very much, bringing national supervision closer and closer to each other. Then having a situation with Brexit, where there is the risk of allowing access to that market, but with diverse supervision, different rules, that in itself, of course, would create significant issues in terms of regulatory competition, of an unlevel playing field. And therefore, to move on equivalence, it's very important that Europe have an understanding of where the UK regulatory system would go to. So Let me stop here, Nick. I think we're going well over time. I want to thank you very much for the very good conversation this morning, Nick.
No, thank you. Point taken, and that's a Northern German speaking to a Dutch. So we will stick and wind down. Just a big thank you to you. I know you'll be still speaking in our FinTech conference, but I think I should nonetheless say, you've steered ESMA through a very interesting period over the last years, nearly decade. And I know from the shortlist that, whoever will succeed you will also be a very strong chair. But I think congratulations to all the work you've already done. And as I say, you've got 4 more months to go. And hopefully let them be calm months is my wish to you. And we look forward to seeing you again in early February. Thank you so much, Steven, for your time this morning. Thanks so much.
Thank you very much, Nick. Thank you very much to all who were on the call. Bye-bye.
Bye. Bye.